Okay, so investment appraisal, big financial topic on A2 Business and IB Business Management. So this is basically the financial tool that helps you justify, decide between an investment opportunity, okay? So there's three methods I'm going to teach you: payback period, average rate of return, and net present value. All three have a different function and a different reason to do it. If we were given a situation here where a business had a decision to buy a machine costing £40,000, the machine had yearly running costs of £10,000, but was able to gain us extra revenue of £36,000, and it was going to last for 3 years. I'm going to show you then how to apply these three methods to determine whether this is a good investment or not. So first of all, what I do is I make a cash flow table, and I do this for actually all three methods, okay? Sometimes if you get a really simple scenario, you think, I don't need to make a table, but it just stops human error. So I have my year column, in, out, net cash flow, and my cumulative cash flow. So in year zero, this is right now, I've got to buy the machine at 40,000. My net cash flow, well, I didn't make anything, I'm just spending 40,000. So my net cash flow is negative 40,000, and cumulative is my running total. So I'm currently running at negative 40,000. Year one, I make the 36 extra revenue, but I have to spend the 10 on the running costs. My net cash flow is 26. 36 minus 10 equals 26. Now, cumulative, my running total, I was negative 40, I make positive 26, which means I'm now up to negative 14. In terms of how is the project paying itself back and when we're going to go into profit. Well, I'm still in debt here. The project has not paid itself back yet. The following year, same thing, 36, I spend 10, there's a positive inflow of 26, which means negative 14 plus that 26, I'm going up to 12,000. I'm in positive figures now. I can actually see the project has broken even somewhere between here, so it's paid itself back. Then the last year, same thing, I make 36, I spend 10, net cash flow 26, 12 plus 26 equals 38. That is the profit for my project, 38,000. It's taken into consideration running costs, and it's taken into consideration the investment at the start. Okay, so now let's move on to payback period. What I need to do is work out exactly when it paid itself back. I can see it's somewhere between year 1 and 2. Okay, to do it, what I want to do is I want to work out what 14 is as a proportion of 26. 14, off the top of my head, I can think to myself, well, that's just over half, okay? If half of 26 is 13, 14, it's going to be just over half. So in fact, we're just assuming we're going to break through sort of just over halfway through this year because of the numbers and the proportion that they are. I'm negative 14, I'm gaining 26. So when did that 26 bring us up to sort of 0? So to do this, what do? I take last year's negative cumulative, 14, and I divide it by next year's positive net cash flow, 14 over 26, and that equals 0.54. I can see that's about right because it's just over half. I multiply 0.54 times by 365 days. I want to multiply the proportion by the number of days, so I'm converting the proportion to days. So I'm actually going to say what day my project's breaking even. Now, 196.5 days in this year here, but 1 year has already passed. So I need to make sure I consider any years that have been before that breakthrough year there. So in fact, I add that together. So I go, right, in which case it was 1 year, and I'm going to round it up to 197 days. 1 year, 197 days. A bit like break even, you can't really have a decimal of a day. It's more easy to take a day as a whole number. So I'm going to say, look, this project paid itself back 1 year, 197 days. Okay, so pretty quickly in terms of my analysis, I'd say actually that's quite a quick return for a project. So the benefits of having a quick payback period are the business is going to be able to make the profit sooner. They probably won't have a cash flow problem as long. Okay, ARR. Average rate of return is basically a percentage which is then comparable to other investments. If I was to put my money into a bank, I'm going to get told, right, there's this much percentage interest. If I work out the average rate of return for a project, I can actually compare it to other investments because they will have a percentage of return as well. And so what we do, we need to work out the profit as basically on average. So the profit of the project is 38 and it lasts for 3 years. So the average profit is £12.67 thousand. Okay, so I just take the profit and I divide by the number of years. Step number 2, I take the average profit, 12.67, and I divide it by the initial outlay, the 40,000. So I'm taking the profit per year and I'm dividing it by the cost of doing the project. Just like if you were to go to a bank and you're being told about interest, they're going to actually tell you how much interest you're going to make divided by how much money you have to actually invest in there. So it's directly comparable. And if we take the yearly profit divided by the cost of doing it times 100, we actually find out that every year we're making 31.67% return. Okay, so that's extremely high, and you would have thought that the directors would be satisfied with this project's return there. Okay. Lastly, net present value. Okay, so I've made a kind of spin-off table here. With net present value, we've got to take in consideration that money's going to devalue through time because of inflation, and we need to then discount every year that we've put in our original table. We need to actually consider that 26k positive net cash flow in year 3 isn't really worth that to us now, because it will be worth less in the future than what we're looking at now. So what we do is we actually multiply it by a discount factor, and we're reducing it to sort of real levels. So the 40 we spend in year 0 is still 40 because it's year 0. There's been no time passed where that money's devalued. So that's still worth 40 to us. So in year 0, we're multiplying it by 100%, and minus 40 multiplied by 1 is still minus 40. In year 1, we take our net cash flow, multiply by the discount table, which you'll be given, 0.91, and so that 26 in year 1 is actually really only worth 23.66 to us. 26 times by 0.83 is now worth that in year 2, and in year 3 we've got a much sort of lower decimal to multiply now. 26 multiplied by 0.76 means that 26 is now actually really only worth 20.28 to us in year 3. So what this system's doing is it's actually making those values more relative to when we're going to receive the money. Now what we do is we add up this column. So you add up the positives, take away the negative. Net present value overall is 25.52 thousand. So we said originally 38,000 profit, but net present value is saying realistically we should consider it to be this value here, the actual, what is it actually worth in present terms? That project's still worth this to us. Now the fact that that's positive and still quite a big proportion of the initial investment, I still think this is a very positive result. Okay, so once you've done all your data, you've done your table, payback period and ARR comes from the original table, you've done your NPV table, calculates your NPV, you probably need to construct maybe a 10-mark question, a 20-mark question, and you've created your own application here. Just remember that in any finance question like ratio analysis or investment appraisal, once you've created this quantitative data, it then goes in your paragraphs as your application. So it needs to be there. If you're able to compare 2 different years, say how much it's improved by, okay? So that's your knowledge application analysis kind of saying, look, is this a good project? Now I'm looking at this project thinking 1 year, 197 days, 31.67%, and a positive net present value. I'm thinking, yes, this is a good investment. That's what my analysis is about. But I do have to evaluate these questions. So, something I need to consider, decisions should consider qualitative information as well. This is just finance. In any decision-making process, there can always be a quantitative result and also qualitative. Maybe the manager has a preference for something. Maybe it might create a bad reputation because staff will be made redundant if we're buying this machine. Whatever it is, we need to consider qualitative factors as well. Can't just make conclusions based on this quantitative data here. Secondly, these are just estimates. We're saying yearly revenue gain in year 1, 2, and 3. That's an estimate, so we can critique this model based on the fact it's estimates. And then lastly, you might be asked a question to do the payback period and make a decision, to do the ARR and make a decision. And so you can always use, do you have all the information to do all 3 models as an evaluation point? Because if you don't, you can say, well, actually, we need to do a net present value because we need to consider inflation. Or if you don't have a payback period, you could say, actually, we'd like to know when it pays back because the business isn't in a great liquidity position, and therefore an earlier payback period would be preferable. So you can always sort of question if you have all 3 together, because a lot of the time you won't, and therefore it's easy to evaluate. You say you need to do all 3.